Okay, welcome to our second class. I wanted to start off um, pointing a couple things out in McGraw-Hill Connect. I don't know if all of you were able to acquire that now, get the textbook and all that. Looks like many of you were, okay, just by what I see some of the results of folks doing their homework and whatnot. But I want to point out that I did figure out how to give you basically all of the homework questions. So you now have every single homework question in Chapter 1. So you'll usually see an organization of Chapter 1 homework, Chapter 1 quiz. Okay, those are the specific ones that I've selected out that we'll probably go through together in class. But then I basically, guys, dumped all the rest of the Chapter 1 homework in these two files for you, or these two links for you, so that you get the maximum benefit of having to acquire the textbook, so you can see all of the homework questions. Okay, and that's what those other two are. Those are extra. Okay, and so it'll say extra questions, and I have to split them into multiple choice versus exercises because that's just how they have it organized. Okay, and then I've started building the Chapter 2 homework. And I got to still put up the Chapter 2 quiz. I'm thinking we'll get to the Chapter 2 homework tonight, I hope, but as you know, I tend to like to talk, so if we take a little longer, we'll eventually catch up with everything as we move along. Okay? Any question on that? Everybody found all that okay? All right. No big deal on the homework, guys. It's 1 point, I think, per chapter homework that I pointed out. So don't worry about clicking through and trying to do all those. You don't get to them, you don't do them right away or whatever. They're there to help you ultimately with the exams. I'm going to give you the points for the homework, the points for the quiz, as long as you're attending class and participating properly and stuff. So don't freak out about, oh, geez, I got to do the homework. They're there to help you practice. They're a means to an end instead of an end in themselves to do well on the quizzes. Okay, you're going to see that in Chapter 2. Also, I actually embedded some example quiz and homework questions actually in the slides there as well for us to look at. Okay, looking into uh, e-learning, and let's see. I think I'm better off just starting over again with that because it likes to give me a hard time for some reason. Open a new browser. Always works fine sitting at my desk, and then I get in front of you guys and it decides to give me a hard time. Okay, just looking at Chapter 1, just so you see, there's the lecture. That's part 1 from 5.7, and then I'll put part 2 from 5.14, and I'll also put that under Chapter 2 as well. Okay, but just so you see how that works, you click on that, and it's basically going to take you out to YouTube, and you can see the lecture there. Okay, I'll point out to you some of this, nonsense that you see on the side here. That is not me. That's more likely that's you. Okay, that's YouTube figuring out something they think you're interested in. So if you see something there that offends you, kind of say, gee, what's wrong with me? Okay, so I just want to say that because sometimes students think I put that. Um, sometimes we get the subtitles to come out. Okay, so I know I talk fast, so sometimes it's worthwhile to have the subtitles sitting down there so you can kind of, and it's got a pretty good batting average. I say it's about the YouTube subtitling is probably a good 80-90%, so they do a pretty decent job. It's not as good as, you know, I forget what they call those individuals that actually do that and sit there live and do it, but it's pretty good. I think it's automated, but it's pretty good. Okay. Okay. Any questions? Can close this. Okay. And so what I want to do then is go ahead and jump us back then to the chapter 1 slides. Okay. And couple of key items that I want to review from chapter 1, since I know it's been about a week or so, and it's been a week. Okay, and remember, we took some time to look at Apple's financial reports, and we noticed that there was obviously the financial statements and the notes there too. And we said that our audit opinion essentially covers that information, right? But in the annual report, there was a lot of other information that was very close to the financial statements that our audit doesn't cover. Nonetheless, we do have some responsibility extends to that, and that's basically to make sure that it's not materially different from what we know to be the facts in the financial statements. So if you had, sometimes they'll put in the MD&A, for example, a chart that shows income over the last 3 years, and they show the line going up. Meanwhile, we know income's been going down. We would be obligated to ask for a correction to that annual report information if it was not consistent with the financials. If management refused to correct the MD&A, since our opinion doesn't extend to the MD&A, what we would have to do is add a warning paragraph in our audit report that says, hey, the financial statement or the supplemental information, the MD&A, is not consistent with the financial statements, right? But our opinion essentially extends to the financial statements, balance sheet, income statement, statement of cash flows, statement of changes in stockholders' equity isn't shown here, but that would be the fourth statement that our opinion would cover. Okay. Now, it is management's responsibility to prepare these financial statements. It is the auditor's responsibility to give the opinion on those financial statements, right? And when we give that opinion, we are saying that the company has been in compliance with the applicable framework, and that could be U.S. GAAP, that could be any other applicable framework, for example, International Financial Reporting Standards promulgated by the International Accounting Standards Board. Okay? Okay, good. And of course, we have to be independent. This adds reliability to those financial statements because of our independence. Now, when we give this assurance, do we give absolute assurance? It is what? Reasonable assurance. And we said there are a variety of reasons, one being that what? We are human. The other reason being that we don't look at 100% of the transactions. We look at a sample of transactions. There's always a chance that a sample will not be representative of the population. And then the third major reason that we can only give reasonable assurance is that maybe management and or their employees are slicker than we are, and they are able to slip something past us because of their fraud, their collusion, whatever, right? Okay, so those were sort of the main things we talked about from there. Okay, the other major thing that we talked about was the financial statement assertions. Okay, and I think I went through quite a bit up here on the board. I think I was, what's your name, sir? Well, I was driving Michael crazy because I was behind his back the whole time, and he's trying to turn his head around and look at what I was doing up here on the board. But what we talked about was the auditor looks at the financial statements as a set of management assertions. So management asserts that assets exist. Management asserts that revenue, sales have occurred. Management asserts that the financial reports contain all complete information. For example, our liabilities are complete. And what we talked about was something called directional testing. in which when we look at the financial statements, we can test the existence completeness assertion by doing a certain directional testing. So if we're looking at the existence assertion, what would we do? We would select an item from the financial statements and then what? Find the supporting evidence that that thing actually exists, right? If we're talking about the completeness assertion, we would start from outside the financial statements. I think we were talking about sales invoices, and we would find the invoices, find the shipping reports, find the customer order, and do what? Take that back to the financial statements to make sure that everything that should be listed in the financial statements was actually included. Okay, so we've got these assertions, and we've got these assertions, and this is the way the Public Company Accounting Oversight Board, PCAOB. PCAOB, remember we said, was created by Sarbanes-Oxley, and they write auditing standards, and we're going to talk more about the standards in Chapter 2, but they write auditing standards for public companies. So if I'm auditing a public company, I follow PCAOB standards. And so they have a set of assertions that you see up here. We talked about existence or occurrence. We talked about completeness. Okay. Now, we also have the assertion, and let's talk about rights and obligations. Let's say I do an audit procedure where I see a piece of equipment listed in the company's financial statements, listed in their subsidiary ledgers. I mean, they don't list every piece of equipment on their financials, but they'd have a total $1 million worth of equipment. We go to the subsidiary level, we see machine number 423, whatever. Okay, so we go and we do an existence test. We say, well, machine 423 is supposed to be in building 11. We walk over to building 11. We see machine 423 sitting there. It fits the description of the machine. So that machine does exist, doesn't it? It went from the financial reports to the actual physical item, right? This machine, what did I say, 423, whatever. All right. Does the company have the right to that machine? It's housed in their building number 11. It's sitting over there. We were able to find it. Have we now satisfied ourselves that they have the rights to it? No. Why not?
It was their subsidiary ledger, wasn't it? Like their subsidiary owns it.
Subsidiary? No, I'm not saying they're a subsidiary. I'm saying their subsidiary ledger. Okay, so remember we have the general ledger, and the general ledger will say equipment, $1 million. Well, I don't know why I'm giving myself such a horribly big number to deal with. Let's say $1,000. Okay, the general ledger will say equipment $1,000, and then remember we said we would reconcile to the financial statements. Financial statement should say equipment $1,000 on the balance sheet, right? Okay, but then underneath the general ledger, we have what we call subsidiary ledgers. We don't mean ledgers for their subsidiaries. We mean a ledger that is underneath the general ledger. And there it would say machine 423, and it would say machine 423 is worth $700, and machine 1190 is worth $300. Okay, now you're saying, well, John, if they only had the two pieces of equipment, big deal, we'll just go look at both of them. But I'm not going to sit here and write, a 10-page subsidiary ledger to make this a more realistic example. But the subsidiary ledger does what? It lists the details of what's feeding into the general ledger, right? And remember I said our first step would be to reconcile what's on the financial statements to the general ledger to what the subsidiary ledgers are saying, right? Once we get satisfied that these subsidiary ledgers or these sales journals, etc., are tying to what's in the general ledger, then I would probably do most of my audit work right here. Okay, so I would select a sample. You say, well, why would you select a sample if there's only two? I wouldn't. If there's only two, I'd look at both of them. But assuming there were thousands of these, I might select a sample, and I'd probably do a random sample. We'll talk about sampling later. And I would go, and in here it would say building 11 and give me some description of where to find that. And I would literally go and find machine 423. That's a machine. I'll make some smoke coming out of it, whatever. Okay. And I would literally go and find machine 423 in building 11, thus proving that machine 423 exists, right? Did I prove that it exists? Okay. So I just tested the existence assertion by going this way, right? Now, and I'm kind of reviewing what I said last time now. Then maybe this is building 11. Then maybe it says in building 9. Doing it to you again, Michael. In building 9, it'll say machine 1190 is supposed to be over here. Well, maybe I start here and I come over and I take that back. That's the completeness assertion, isn't it? Okay, and again, two pieces of equipment is not a realistic example, but again, I don't want to write 52 things over here. Okay? All right. So my question, Michael and everybody, is if I do this step, start with the subsidiary ledger, go over to building number 11, find machine 423, I've proven that it exists, haven't I? But do they have the rights to that machine? We don't know by that procedure, right? So what would I do? I would apply another procedure now to see, hey, can you show me some sort of evidence of ownership, invoice that shows that you purchased this, or something that shows that you have the deed or the rights to this, whatever it is, right? And maybe by asking that question, management says, oh yeah, that's right, we're renting that. Okay, well, if that's the case, then what? If they're renting it, they can still report it as something that's on their financial statements, but we would expect what? Some sort of footnote that talks about their rental agreements, that sort of thing. Okay, so we would look for rights that way. Okay, so we've looked at rights. How about obligations? Okay, what happens here? Let's say I have agreed to serve as a co-signer on a loan. Do I have an obligation? I absolutely have an obligation. Now, I may not have to put that liability on my financial statements, but there would be an expectation that what? In my footnotes, I would certainly talk about what? That I have some sort of obligation on this, right? Or maybe I own this particular asset. Maybe I do own it, but maybe there's a lien against that of some sort. Well, that's an obligation. Obligation often gets into beyond just its sort of cousin completeness, often gets into disclosures of different things that I'm obligated for. Okay, so we've got existence, we've got occurrence, we've got obligations, valuation or allocation. Okay, let's talk about valuation. Let's say I go to the subsidiary ledger now of my accounts receivable, and I select out Michael as a customer of my client. So I send a confirmation to Michael and I say, do you owe $10,000? And when you look at those confirmations, and we'll talk more about this, we get into accounts receivable and stuff. Do you owe 10,000? Literally, in some forms of confirmation, there's a box there to check yes and check no. So I ask him, do you owe my client $10,000? And Michael checks yes. Does that account receivable exist? Yeah, I proved the existence assertion because I pulled from the subsidiary ledger something that said $10,000 is owed by Michael. Michael came back and said, I'm here, and checked the box and said, yes, I owe that. Is it valued correctly? Did I prove the valuation assertion by Michael's check of the box, yes, I owe 10,000? Michael says, yeah, because he knows he's got 10,000, right? Do you?
Yeah.
Okay. Well, that's lucky for you. Okay, there may be some people that check that box 10,000 says, yeah, I owe 10,000. Good luck getting it from me because I'm headed to bankruptcy court right now. So you don't prove valuation by someone agreeing that they owe it. All you've proved is that they think they owe it. You've proved existence, right? So what we would do is perform another procedure that would help us with valuation. That procedure would likely be looking at the company's aging of accounts receivable and seeing how many of those are in what? The 90 days and more past due category. And if we see a lot of those, we would expect that the company should do what? Should put more in the allowance for doubtful accounts maybe than they are, right? And we might do our own little procedure to see if we agree with what they're saying should be in the allowance. Okay, so you kind of see a little bit of a story building here, which is what? For the assertion, different procedure. The auditing procedures that we'll be studying in this class line up with what? The assertions. And as you start to understand what these assertions mean and what it is the auditor is concerned about and trying to prove, then it makes identifying the correct audit procedures very easy. And one of the things that students struggle with sometimes in auditing is, I don't know, all of these procedures look like they might do something good. When you start to line them up with the assertion and how they help us to gather evidence to support those assertions, and we look at the financial statements as being made up of assertions, then the audit procedures start to feel more real to you as opposed to just something that's listed on a page that you're supposed to do. Okay? Now, when we talk about allocation, even though it doesn't say it, it's talking about depreciation. What do? We sit there and we take what? We take an asset, we buy it, we go, has a 10-year life. We think it'll have this much salvage value. We're going to use straight line depreciation. We're going to allocate the depreciable base of this asset over the next 10 years, whatever, right? Isn't that allocation? Okay. So when you look at valuation, you look at allocation. Does management really know how much they're going to collect on the account receivable? Do they know for sure? No, it's an estimate, isn't it? Does management really know if that asset's going to last 10 years or not? No, it's an estimate, isn't it? So when we're looking at allocation and valuation, we're looking at management estimates, and we're going to see that the best way to audit management estimate is to recalculate. Recalculate by what? Coming up with your own estimate. Well, yeah, you say that this is what's happening, this is how much you're going to put in the allowance for certain aged receivables. Do we agree with that? Okay. Okay, good. Presentation and disclosure. Disclosure deals with the footnotes. Have they disclosed the things that they're supposed to? And the best procedure, I got to tell you, for disclosure is a disclosure checklist. All the major publication standards put out disclosure checklist, and you just go through and see that they have basically all the disclosure that they're supposed to have there, right, for different things. When we talk about presentation, that means is it classified correctly on the financial statement? So let's say management has a 5-year loan that's going to come due in installments. The company has a 5-year loan that's going to come due in installments. And let's say the first installment is going to be due on January 1st of the new year. And our financial statements are dated December 31st, right? The remaining 4 payments to pay this thing off in 5 installments will happen each year thereafter. How should that be presented on the financial statements?
First year is a short-term application, and then 4 years afterwards are long-term.
Should be long term, right? Okay, good, right? 1 year, the first year should be up in current liabilities, the other should be down in long term, right? More or less, right? Okay, but that's the presentation type issues, okay, that we look at. Okay? Okay, now these are, geez, this is upside down. I feel like if somebody walks by, they'll say, gee, that class must be in distress because they're looking at the slides upside down. Okay. All right, but let's go ahead and let's take a look at the same set of assertions, guys, pretty much. But now we're talking about the Auditing Standards Board. Now, we're going to see when we get into Chapter 2 here a little bit later tonight that we have the Auditing Standards Board, which is part of the American Institute of Certified Public Accountants. Anybody ever heard of the AICPA? Okay. What's some important things that the AICPA does? American Institute of Certified Public Accountants. Huh?
Then they create the CBAs.
Yeah, that's what I'm thinking. Maybe you guys might be concerned about. They write the CPA exam, right? AICPA, American Institute of Certified Public Accountants. Good. But they do a lot of things. They have a members relation. They have a lobby function where they go to Congress and say, you know, you really should limit the amount that people can sue accountants for and all that kind of stuff, okay? One of the things they do is they have an Auditing Standards Board. And what they do is they bring in individuals from different size firms, Big Four firms, regional firms, local firms, and they bring them in on a part-time basis to write auditing standards. And they write these auditing standards, and they do this on a part-time basis. Now you say, well, why are they part-time? Can't they find full-time work? Why are these auditing standard boards member part-time? Let me ask you a question. Is FASB a full-time board, the Financial Accounting Standards Board, a full-time board or a part-time board? The Financial Accounting Standards Board, the entity that writes the accounting standards. Full-time or part-time? 7 members. Why 7 members on the FASB?
So that they could always have a different vote for one thing.
Yeah, it's a simple majority. 4-3 vote will pass. There was a short period of time where they tried to dampen the FASB, and they said it had to be supermajority, that everything had to be passed 5-2 because they were trying to slow them down. And then, you know, cooler heads prevailed, and they went back to a simple majority, 4-3. Simple majority, FASB, 7-member board. They set all the accounting standards in the United States, right? And the SEC, Security Exchange Commission, has recognized them as the entity that sets accounting standards, right? We have the PCAOB writing the auditing standards for what? For public companies. The Auditing Standards Board, the part of the AICPA, writes the auditing standards if you're auditing a non-public company, if you're auditing a private company, a non-public company, a non-issuer, I should say. Okay? So the Auditing Standards Board is a part-time board. How come? FASB full-time, Auditing Standards Board, ASB part-time. How come? Well, they do only write for private companies, so they must not be that bad for them. Might be one way to look at it, but that's not why. They auditing, unlike accounting, where you can sit up in an ivory tower and say, this is what should be. And this is what needs to be in the financial reports. It's much more difficult to do that with the auditing standards because I can sit there all day and say, this is what you should do, auditor. And then there's the question of what? What can you do with the circumstances that are going on? And you can't always do everything that someone thinks you should do when you're doing an audit. That generates a lot of what we will see are the exceptions when we look at the auditing standards. They'll say, this is what you do. However, you could do this, you could do this, you could do this in the absence of the ability to do the primary procedure that they think you should do. So this Auditing Standards Board has to be practitioners. They have to be people that are what? On a day-to-day involvement with actual auditing, and so they come in on a part-time board to write these standards. Okay, now when they come up, and we'll talk more about that a little bit later, their standards versus the public company standards. Now when we come in here, notice we still have occurrence, we still have completeness, we still have accuracy. Okay, accuracy sort of being similar to our valuation assertion. Okay, but when they put these assertions, they break them into three categories, something that we didn't see in the PCAOB version of the assertions. Okay, so let's look at them in terms of these categories and understand something about what these categories are about. Let's see if I can flip into tablet mode without the whole world coming to an end here. Where am I? Okay. All right, so let's just take a look at assertions about events and transactions. And I want you to put down here, these are our journals. Journals, I don't know if you have the slides, but journals, it's probably not a bad idea, guys, to bring the slides with you, because sometimes I'll write on them like this. Journals, some of you can read my writing. Current year. Okay, journals current year. For example, we have a sale this year. We record that in the sales journal, don't we? We would debit cash and credit the sales, debit accounts receivable, credit the sales. So our sales journal is an example of a journal that would be covering transactions for the current year. Okay. Now when we look at the second category, and we talk about account balances, these are our ledgers. Say the general ledger, could also be subsidiary ledgers, our ledgers, and this is all years. All years. So what does that mean? We bought a piece of equipment 2 years ago. That piece of equipment has a 10-year life. Should it still be in the ledger 3 years, 2 years later, however long ago I said we bought it? 2 years later? It should still be there, shouldn't it? Okay, so we have a set of assertions that we look at when we're talking about our ledgers. Regardless of the year that that transaction took place, we want to see that that's properly represented still in the ledgers. And we have what? We have our journals covering the current year transactions. And we have a set of assertions that we put there, right? And then we have a set of assertions that we put for our presentation and disclosure. And I think the easiest way for us to look at that is footnotes. Just think of footnotes. Okay, so with those three categories of assertions, journals covering the current year, are what? Ledgers covering all years for our account balances, and then a set of assertions for our footnotes. Let's go through and see how the ASB has organized the assertions. And so you start to look, an occurrence, what happens? We pull a sale from the sales journal, and we sit there and we see that it's listed in the sales journal, and we go and find the sales invoice. Did we just prove the occurrence assertion? The journal says that a transaction, Michael, I'll put on this side for you. Here's my sales journal. Transaction number 1, sale, 100,000. I select this sale. I find the sales invoice. I find the shipping doc. I find the customer order. Did that sale occur? And I pulled it from this year's sales journal, right, to see that it occurred this year. So I know that that's a proper sale for this year. Okay, good. Completeness. What do? I come over here, sales invoice, number 3. I come over, I find it, number 3, over here, sale 3, 50,000. Is my sales journal complete? So I did a completeness test, didn't I?
Yes.
Okay. Now, the reason they put this term cutoff next to completeness, they used to have it as a separate assertion. And I don't know, I think maybe it should either be a separate assertion, or if they're going to put cutoff with completeness, they should put cutoff with existence. Because what I'm going to do is I'm going to select transactions that happen near year end. So I'm going to look at a sale that occurred December 31st. And it's listed as a sale of this year. It occurred December 31st. So it's listed in the sales journal December 31st. They shipped the goods. I find the shipping document. They shipped the goods on December 31st. Say 2019. We'll use this year. Is that a 2019 sale? Maybe. Why not? They shipped it.
Depends on when the ownership of the goods transfers. Whether it was when they shipped, when it arrives.
Excellent. So we're going to sit there. What's your name again, sir?
Stu.
Stu. So we're going to sit there and we're going to look at the shipping terms, aren't we? We're going to see if the shipping terms were what? Free on board shipping point. Yeah, we got a sale. If the terms were what? Free on board destination. I don't care that they shipped it at December 31st. If it didn't get, and if they shipped it on December 31st, I doubt that it got to the customer by December 31st. That should be a sale of 2020, shouldn't it? And not 2019. So what happened? That is an existence issue, isn't it? Because it was listed as a sale and it wasn't actually a sale. So that's why I'm thinking cutoff should probably be a separate assertion, or if you're going to put it with completeness, put it with occurrence, because cutoff goes both ways, doesn't it? Is there something that happened near year end that's included in this year's financial statements that shouldn't be? Or conversely, with the completeness assertion, is there something that should have been included that was not? For example, I'll go to the sales journal for early into the next year, and I'll look for a sequential order of the sales invoices. Okay, so I'll sit here and I'll say, well, the last sales order, the last sales invoice, whatever, last one of 2019 was sales order number 300. What should be the first one of 2020? Not a trick question. 301. But I look, and it's 305. And I'm like, what happened? What happened to 2, 3, and 4? And they say, oh, thanks, auditor. That was Bob. Bob used to screw that up all the time. We let him go. Thank you. Here they are. We found them in Bob's bottom drawer. Okay, and so what happens? Now I just did a completeness test, didn't I? Because they should have had some sales over here that they didn't. Now remember, we talked about professional skepticism, and our professional skepticism siren was going off in our head when there was that sale that they tried to include in 2019 was actually 2020 because of the shipping terms. But my professional skepticism wheels are turning a little bit here because maybe they're satisfied with the 2019 sales and they tried to do what? They tried to scoot some. They're waiting for us to leave so that they can do what? Slap them into 2020, and what? Then they'll be 302, 301, 302, 303, 304 will be sitting there after we turn our back, right? Because they want to stick them over here. Okay. That's a completeness. Those are both cut off, though. Both what? Should something that that wasn't, was there something that was included that shouldn't be? Was there something that wasn't included that should have been, right? So cutoff can go both ways. Notice, though, with cutoff, it's all about the end of the year, near the end of the year transactions. Okay. Um, why do you think PCAOB ignores cutoff? Why does PCAOB not have cutoff? PCAOB looks at it and says, well, we got existence, we got completeness. Cutoff fits under those, doesn't it? We don't have to call out cutoff. You should know that transactions near year end are what? Are things that we're going to have to take a look at, right? And so we don't have to call it out as a separate assertion. Meanwhile, for our transactions, and notice, guys, we're transaction events, things that happen this year, AICPA, because they're all about these categories, like to call cutoff out, right? Okay. All right, good. Accuracy is going to be very close to did we record it at the right value. So we might take the sales invoice and do what? Multiply the sales price by the quantity to see that they calculated that correctly. Okay, accuracy. Classification, has it been posted to the proper account? So once we look at the journals, did they take everything and post it to the proper accounts? Classification. Okay. Existence for our account balances, existence, completeness, but now instead of limiting our look to what? This year's transactions, we're back over here looking at a piece of equipment that maybe was acquired several years ago, right? Okay. When we look at our financial or balance sheet, notice now again we're interested in accuracy and valuation. Okay, valuation is things were valued correctly, and we're interested again in our rights and obligations. Just because we saw a piece of property that they've acquired doesn't mean that they actually own it, right? Have they disclosed any liens that they have on their equipment, etc.? Okay, footnotes, and basically footnotes are telling us, right, occurrence, rights, and obligations. If I have a lien, I should be disclosing that properly in the financial statements, right? If I'm sitting here, are all the proper disclosures there? Again, disclosure checklist, completeness, classification, and understandability. If I have a restriction on my retained earnings, how should I present that on the financial statements? Huh?
Has its own line item? Breakout.
Line item breakdown, I should show my what? I should show the cash associated with that restriction as restricted cash. I should show retained earnings as appropriated, shouldn't I? Okay, so these are the kinds of things that would fall under classification. Accuracy and valuation. Let's say I have an asset that I'm carrying at historical cost. Would there be any requirement that I might actually disclose the fair market value of that particular asset? Potentially, I still may want to disclose the fair value of an asset that I'm carrying at, say, historical cost, right? Okay, so that would get into disclosure, get into valuation. Okay? Okay, so these are the assertions. I think that it's important that you know these assertions, but I think it's more important that as we move along through the discussions and we really start digging into some of the audit procedures, I'm going to always push you back to the assertions and keep pointing to you. Why was this the correct answer for this procedure? It's because the assertion that we're trying to audit. Okay? Okay, good. Any questions about these? All right, good. Professional skepticism. Okay, and we have said that professional skepticism is something that we keep in mind throughout the audit. Okay, so notice that inquiry alone is never enough. So we're always going to look for some sort of corroborative evidence. Unusual financial trends need investigation. Now, how would we identify an unusual financial trend? What would make it unusual? What might potentially make something unusual?
Deviates too much from historical figures, sales, average.
Yeah, I mean, the auditor develops an expectation, right? And that expectation could be based on what would be reasonable for percentage change from one year over the next, doing a horizontal analysis, longitudinal analysis, year over year analysis, okay? Vertical analysis, maybe as it relates to a certain base, okay? Industry trends. How are you showing 100% increase in your sales when the rest of the industry was showing decreases in their sales, right? So the auditor develops a set of expectations and compares that to what the company is showing, and that might identify an unusual transaction, right? What I'm describing to you is something called analytical procedures, and auditors are required to do an analytical procedure during the planning phase of the audit and in the final review phase of the audit. So we would literally sit there and do analytical procedures at the beginning and the end of the audit to see if anything weird jumps out at us. This is because of our requirement for what? Professional skepticism. Okay, you just don't believe everything that management tells you. Okay. We must be skeptical because of the potential conflict of interest. Management wants to portray the company's operations in best possible light, and we want a fair and accurate, okay, professional skepticism. Now, does this mean that we always assume that management is lying? Yes, yeah. You say, yeah, you always assume they're lying.
I think so.
Huh?
Skeptical, right?
Um, no,
Oh,
you don't assume they're lying, but you listen to what they're saying and you bounce it against what you would expect to be reasonable. I'm trying to think of a specific example. Yeah, okay, I got one. I was on an audit, the GAO, and they asked us to look at, the Congress asked us to look at the Miami-Dade Housing Authority. And what had happened was the Miami-Dade Housing Authority got money to revitalize their public housing. So what they did was they came up with this idea that they were going to tear down the existing public housing, the old-fashioned towers, which become like these, basically, these urban prisons that are these towers, and there's all kinds of crime and everything else going on in these huge towers that they were using for public housing. So HUD, the Department of Housing and Urban Development, had said, it's probably better to flatten some of that out, and they like to have like mixed housing where they have regular income housing along with low income housing, that sort of thing. So we're not just, storing these people in these horrible, I'm going to electrocute myself on the projector. We're not just storing people on these horrible high-rise public housing. So Miami-Dade gets some money to do this under a program called Hope 6, and they go and they tear down all the high-rise housing, and they temporarily place people in some really bad, almost homeless type situations. But the idea is, well, we're going to rebuild it and it's going to be better. Well, guess what? They tear everything down and they run out of money. So they don't have the money to put the stuff back up to house these people. So now we've got crowds sitting there saying, where's the housing? Where's the housing? Miami Herald's getting involved. It's a mess. So Congress, the congressman in the Miami-Dade area, asked GAO to look at that. Well, my office, GAO, we don't do that. My old office, my retired office. We don't do that. We don't go and look at one thing. We're not going to get involved in an investigation and fraud allegations and all that. We're going to rise up from that, and we're going to talk about the entire system. and what's wrong with it. So, as tended to be the case, I get a funky assignment like that. I think they were doing it on purpose. Thinking, oh, we got something weird, some weird, funky assignment that nobody we can't put Phil on that. Phil's an up and coming guy. Let John handle it. I used to say, at least when I worked in the hospital cleaning toilets, they gave me gloves to clean up shit. Okay, here I gotta go in and I gotta no gloves. Okay, so anyway, so we go and we start to look and we meet with HUD. And I say, well, look, I want to understand what it is, HUD, that you do with the financial reports of these housing agencies. I mean, what are you doing to see if problems are developing? Are you developing a set of indicators? I'm pointing, even though I've changed the slide, something that is what? Unusual, standing out. Do you do analytical procedures, etc.? And they say to us, oh, no, we can't do that because many of the housing agencies like Miami-Dade are part of the county. And so since they're part of the county, we don't get visibility as to the details of what's going on with that housing agency. And you're giving me the same look that I had in my professional skepticism. I'm like, that can't be right. Because I know that entities that receive certain amounts of federal financial assistance, like a housing agency does, has to receive a single audit. It's the law. If you expend $750,000 or more in federal financial assistance, that entity has to be audited. It's a federal law that's been on the books since 1984. So what they just said to me can't be. And so we walk out of the meeting, and some of our staff, frankly, are saying, well, that's it. We're not going to be able to look at their financial reports. I'm like, something's wrong. So I go to the database. It's on a website that you can go to. It's the Federal Audit Clearinghouse. It's maintained by Census, where they have a database of all entities that received a single audit, and I search on Miami-Dade. Here's the report. Okay. Excuse me, what is this? You told us that here it is right here. Here's the audit report for the Miami-Dade Housing Agency. I ask you the question again, what are you doing with these reports? And so then they sent the guy who actually knew what the hell he was talking about, and he came and sat with us for a week. And what we did was we developed a set of indicators that would show whether or not housing agencies were financially distressed, and we compared it to HUD's set of indicators, and we found, I think of the 3,100 housing agencies, we found 300 that HUD's indicators were showing they were in good financial health. Our indicators were showing that they were having problems. For example, you could see right on the financial report there was a liability line item called outstanding checks. It was bounced checks. It was checks that the entity had bounced. Those are liabilities, right? But they called it this cute outstanding check thing instead of calling it bounce checks. And HUD wasn't looking at that. And we found over 300 housing agencies that were bouncing checks on a regular basis that HUD system was saying they're having good financial results. They're in good financial condition. And so, again, the story here is professional skepticism. You don't assume they're lying, but if something just doesn't, and I call it your spidey sense, doesn't match with your spidey sense, that's when you start to go, wait a minute, and you start to do some additional questioning and additional investigation till you get to the what they're saying here, the fair and accurate truth, right? Because HUD wanted us to believe that they were doing all they could, but geez, it was just an enigma inside of a rumor that they couldn't get to because it was buried in the county. It was not. Okay? Okay, good. Come over. And we've talked about the different types of services, assurance, attest, audit. Okay, and the public accounting profession provides these different services: financial statement audit engagements, assurance engagement, attest. Compilations and reviews are a little bit different than audit. In fact, they're a lot different than audit. I don't know why I say a little bit. They're a lot different than an audit. And we'll talk about these towards the end of the class a little bit. What happens? An audit is a positive assurance engagement. By positive assurance, the auditor tells you what's in their head. In my opinion, the financial statements are fairly presented. That's a positive assurance. That's an audit. I'm telling you what I think about something. Okay? An auditor could provide an assurance that is a negative assurance. And in that sort of assurance, the auditor tells you, I am not aware of any material modifications that need to be made in order for these financial statements to be in accordance with the applicable framework, US GAAP, IFRS, whatever it is. I'm not aware. Now the auditor is telling you, well, there's nothing in my head that tells you that the financial statements are not fairly stated, as opposed to, in my opinion, they are. This is what I think about them. Now, let's think about this for a second. Let's say I have two chairs, and you're going to sit in one of these two chairs. And for chair number one, this would be chair number one, use your imagination. For chair number one, I tell you, in my opinion, if you sit in this chair, it will not break. For chair number two, I tell you, I'm not aware of any structural problems that would cause a chair to fall if you were to sit in it. Which chair do you want to sit in? Good, you guys were listening. Sometimes I get my feelings hurt when my students go, huh? Which chair was chair number one? Because we were like thinking about ice cream. Okay, so good. So chair number one is the one that I gave a positive assurance to. You feel much more comfortable sitting in that chair knowing it's not going to break, right? So let me ask you this. Why would anyone want the assurance for chair number two then? I mean, why would you ever order that assurance? It depends how far the chair is off the ground. What's your chance of getting hurt if I'm wrong in my negative assurance? So if it's a chair that's 50 feet off the ground, you're going to say, dude, give me the positive assurance. If it's a chair that's 2 inches off the ground, all you're going to do is look a little silly if it falls. You're like, give me the negative assurance. Why? Because the negative assurance is cheaper than the positive assurance, right? So it really depends on the user's need with these financial statements that would determine whether they were going to go for the positive assurance audit or the negative assurance. And what I just described to you is a review. Review has a negative assurance. Okay? Now, there's also compilation here. Compilation has no assurance. I give no assurance in these financial statements in a compilation. All I do is take information that is the representation of management, say a general ledger, and turn it into a set of financial statements. And I give no assurance on that at all. Now you're saying, well, John, if you pulled the numbers out of the general ledger and you compiled those into financial statements, shouldn't you be able to give an assurance? No, because I don't do any work at all to confirm what's in the general ledger. If management says cash $10 million, I put cash $10 million on the financial statements. In a review, I would at least have to inquire and do some analytical procedures. So I would compare this year's cash to last year's cash, and if there was some huge jump, I might start asking some questions. However, I am not going to do the things that we would do in an audit, which is if they say cash $10 million, I'm going to test the existence assertion on that cash by doing what? Sending a confirmation to the bank and asking them directly to report directly back to me whether or not there's a $10 million balance in that bank account, right? Okay, so the higher the assurance, the more audit work we have to do. And in some cases, we'll do no assurance, and we will simply compile the financial statements. Okay? Tax services, consulting, advisory. Where are you guys going? Assurance, tax, consulting. Sounds like an advertisement for one of the CPA firms. We are Horsten and Horsten. Assurance, tax, consulting. Which one are you going to?
Maybe tax.
Tax? Tax consulting?
Yeah, that's the real name. I'm pretty sure.
It means that you'll. Well, to me, here's the difference between any assurance people? Nobody? None of you are assurance bound? All tax? Huh? Your assurance, okay. So don't be offended by this, okay? Because I was an auditor I was an assurance person, okay? I never liked tax. Sorry, guys. My brain doesn't work that way. My brain doesn't work. Okay, take 1 million minus 300,000 unless the amount exceeds the half of last year's and divide by 2 and add 300 and that's the tax. The hell? Excuse me? I'm not doing that. Okay, so was always an assurance guy. I'm looking for the existence assertion. How do I audit existence? Well, I go and I find the thing. There it is. My brain can handle that. Okay. Now, having said that, to me, the tax consultant, the tax person, is the doctor trying to cure the ill patient. The patient is ill, they need a cure. We need to figure out how to get out of this tax situation. Well, curing the ill patient, you can go as far as you want in studying that until that patient is well. Audit, I'm afraid, is the well patient in which we're looking for disease. And so we're sitting there and going, breathe, okay, turn over, breathe, okay, sit up, breathe. Meanwhile, I'm sitting there going, I can't wait till I get home tonight. And meanwhile, the person's, chest is rattling cancer, and we're going, breathe. Okay, so, no, not quite. Okay, because these days, and I mentioned that last time, more and more, they're expecting us to do much more with their data, using data analytics, and provide them much more consulting type stuff. But that's how I would describe the two different areas. I think if you like tax, you should go into tax. The only hard job in this world is the job you don't want to do. Okay, so if you don't like tax, you can't go into it. Okay, but you can still do a lot for your clients. Okay, public accounting firms, you guys are shooting for what? Right here? Partner? No? I have a partner who recently retired from PwC as a partner. Do they put some salaries up here? No. Some of these slides, they show the salaries of these people, and I always laugh at the salaries because they put like a salary. You can be a partner at a CPA firm and make $150,000 a year. If my friend Alfred was told that he was making $150,000 a year, he would weep openly. Okay, so these partners, you say, I don't want to do it. They're doing okay. Okay, they're doing pretty darn good. They're pulling down for some of these big firms and stuff. I have another friend who's a partner in his own firm. And he had bought a brand new house in St. Francis Woods. And I went, it's a very nice area in San Francisco, so I went to his housewarming party. I'm like, so tell me how you pulled this off. He says, you work for somebody else, right? And I said, yeah. He says, I don't have anything else to say to you. Okay? So if you want to make money in this business, having your own firm is a good way to go. And the lifeblood of any starting firm is the tax side. I'm sorry. That's what keeps you afloat. But if you don't want to be a tax person, you can partner with a tax person, and then you can handle what? The audit part of the firm's activity, and you can kind of keep the whole firm viable throughout the year with different engagements and stuff. Okay. Okay. but you should be shooting somewhere in here. Okay, if not, you're going to be in the manager level. Probably you're going to end up what? Going out of the firm at some point in time, picking up a controllership, picking up a CFO-ship. Maybe your clients are startups and you get involved with one of these startups, and what they do is they may not give you as much cash compensation, but they're going to do what? Give you stock options, and then when the company finally, goes to IPO and all that, you cash out, right? Okay. The only thing to be careful with those startups is you go in and you're sort of, running everything in that company and is from the accounting function, and you're keeping them, going forward. And then sometimes what they do is they screw everybody. When they're getting ready to go IPO, they turn over the entire staff at that point in time. So you got to be a little bit careful, because that's when all of a sudden you got, 6'2" security guards standing next to you at the desk saying, okay, well, it's time to clean out your desk, and you're like, what happened? I had that experience. I have a friend, she's all of 4'11", and here comes this big old dude to escort her out. It's like, I don't know, give me a break. And she was very upset because she was working for a company that she was, they were getting ready to go public, and she thought, hey, this is going to work out for me. And then they pulled the rug out from under her just before they went public. So you got to watch out for some of these, the way they do some of these things. But anyway, okay, this is the revenue. What is this, alphabetical order? Yeah, must be alphabetical. I think PwC still. Anyone here going to PwC? Not yet. Is PwC showing up here on campus? Are you seeing them? PwC, do you see them around?
I don't think I saw them at the last meet the firms thing.
They don't come. They don't want to come.
Oh,
Yeah. I sent an email to a contact that I have at PwC asking them how come they're not here, and they sent me back this link as to where if students want to apply, they can apply electronically and stuff. And I'm like, that's not what I asked you. I asked you, why are you not here? So I'm going to have to figure out a way to say that.
I think I actually asked that question to one of the recruiters because through Alpha, I get like a lot of their events. So I went to, before I signed my offer with Deloitte, I went to a few of their events to try to recruit with them. And from what I like spoke to the people I spoke to, they're trying to do more of their recruiting through events, through like meeting with candidates who go out to them instead of them going to schools, which is kind of weird. But
Okay, bullshit. Okay, not that you're saying bullshit. I'm telling you it's bullshit, and I'll tell you why. Because when I taught at UC Berkeley, they were all over me. Oh, do you want us to come? Oh. I have someone from PwC come talk to my Stanford class every quarter. Okay, they lie. So I'm going to have a conversation. I don't know what, because I don't like that. And I'm not saying that they have to come to meet the firms in that, but they could come here and present their leadership program, for example. They have a leadership program that they encourage at the state schools. They could come here and talk about the nature of the work that they do and stuff. And so that's going to be my comment back, hopefully more diplomatic than I'm making it right now, which is to say, I appreciate this information. I'll make my students aware of it. But, what I was really looking for is the type of involvement that I've seen at Berkeley, where you come to things that I've seen at Stanford. You've done me a solid to come there. Um, they even went to a Loney College in Fremont, a community college, and came and spoke there one time. And the reason they did was because there's a PwC alum that teaches there that they like. So it's you know.
yeah.
So we'll keep working on that because they should be here. The other firms are here. Okay. Do you see the others?
I saw them.
Okay.
Did you guys go to meet them? Yes. Yeah, they were there.
They were there?
It seems like KPMG was the most present.
Okay. Well, and that's been the case. That was the case at some of the other schools too, or KPMG. Even during the downturn with the economy, KPMG was still there. Okay, let me shut up before I get in trouble, though. I'll stop right there. Okay. Cut. Okay. All right. The type of services. Okay. Now, some services are prohibited. So you cannot prohibit it if you're going to be auditing the financial statements. So if you're going to be auditing the financial statements, this slide is showing you services that you cannot provide to an audit client. For example, bookkeeping services. Makes sense, right? How am I going to be doing the bookkeeping, then turn around and say, and I audited the financial statements? I'm auditing my own work, right? Okay, that is prohibited service. Okay, design or implementation of financial information systems. I design the system, and then I turn around and I sit here and say, oh, okay, this system is good. Yeah, well, I guess you better say that since you designed it, right? Now, I'll save the story for later when we talk about ethical stuff. Appraisal or valuation services. Okay, you help them to appraise something. Valuation was one of our assertions, wasn't it? Okay. Internal audit outsourcing. So I sit here and I say, well, I'm going to function as your internal auditor. Internal auditors do what? Internal auditors make sure that the system of internal control is working correctly within the company. And they report directly to the board of directors. And it's sort of an insulation inside making sure that our internal controls are functioning, achieving their objectives. If I provide that service as one of these CPA firms, then when I come in and I do a study and evaluation of the company's internal controls, I'd be studying and evaluating my own function, wouldn't I? That's a conflict of interest, right? Now you look at this list and you're like, John, why do we have to sit here and see this list? This is a common sense list. Of course, you can't provide these services that are up here contemporaneously with the audit. And the answer is we need a list because companies used to do this. They used to do these things and audit the financial statements. What happens? Enron, WorldCom, Sarbanes-Oxley comes down and says, since you don't get it, we'll tell you the services that you cannot provide contemporaneously with the audit. Okay. They don't have it up here as, oh, here it is. Yeah, they do. Professional service firms may provide client tax services with some restrictions and other prohibited services to audit clients of the company's audit committee. Professional service firms may provide client tax services. So what does that mean? And then I'll tell you what they mean by some restrictions. I can audit the financial statements and prepare the tax return of the company. Perfectly acceptable. That's okay. Can I prepare the tax return, personal tax return of the CFO, the CEO? That's the limitation they're talking about, because now what? Now you've stepped into an advocacy role with somebody that you're supposed to be what? Auditing their management stewardship. So you can't do that. So remember I mentioned my friend that was a tax partner at PwC. He's retired now. We'd go out, whatever, and he would tell us the stories of how he grabbed one arm of the client, which was he did high wealth clients was his area, and so he had as his client the CEO of the company, and the assurance people had, when Sarbanes-Oxley came down, the assurance people had the other arm, which is they had the audit engagement, and they would pull and pull until the baby split in half. No, whatever, I guess, one of them won the tug of war. I guess there were some backroom deals and stuff that were made. But that was a big deal at that time when Sarbanes came down with that. You can't do both of those. You can't do the personal returns of high-level management individuals and the audit of the entity.
I have two questions actually.
Sure.
So if you do audit with one of the big four, when
You don't have to rotate firm. You have to rotate partner every 5 years. And this is a public company rule under Sarbanes. So if I'm the partner for an audit engagement, and I'm the partner for 1, 2, 3, 4, 5, in that after that 5 years, in that 6th year, you have to take it over. I rotate it to you, and it goes to another partner. Okay, so it can still say in the firm, but the partner in charge, the auditor in charge, has to rotate every 5 years.
Only the partner, not the audit team?
Huh?
Only the partner?
Well, audit teams come and go. Okay, so so it's unlikely that you would have other members of the audit team stay on that engagement for that long. I mean, they could, but I'm sure there's some rotation policy there as well. And I think that's a good part of Sarbanes, that they require that, because I was on engagements where we were looking at customs. We were looking at customs, how they dealt with seized drugs. So when somebody's smuggling, say heroin into the country, and I didn't look at any one particular person for any reason. Well, what are you looking at me for when you mention heroin? Okay, when they're smuggling someone's smuggling heroin into the country, they get caught. And so then what customs has to do is they have to hold that in an evidence safe as evidence for the trial when it finally comes. And sometimes these trials can happen way later, right? And so here we come with the no glove assignments again. So the Inspector General for Customs was going to go and observe the counting of the seized drugs in the warehouse. And somehow it ended up that GAO was also going to watch the IGs watching Customs take, because we have audit authority over IGs. So there's my phone one day. John, I need you to go down just for a day over to the Customs seed drug warehouse. If I tell you where it is, I'll have to kill you. It's just an ordinary looking building in downtown San Francisco on Sampson Street somewhere. And, you walk in, and then there's these, safes full of drugs. We need you to go over there and just observe. It's not going to be a big deal. You can wear jeans. Okay. So I go over. We start observing. They can't find a bag of heroin in one of the safes. They're looking and they're looking, they can't find it. So now I'm like, well, I am not going to be involved in a freaking, situation where a bag of heroin goes missing. I'm like, look, guys, where are you? Okay? So then the IGs and Customs start ganging up on me. Well, you're just supposed to be observing here. You're not supposed to be interfering. I'm like, I don't give a damn. You can't find. So then they get on the phone to Washington, and they have somebody from the IG office in Washington telling me that I need to back off. And I'm like, okay, I do take orders from Washington, you're right. GAO Washington, not from the IG Washington. So thank you, but no thank you. So we keep pushing them, and they finally found it. It was in another, it all reconciled. It was in another safe, and it was mislabeled that it was in that. When I say safe, I don't mean a little safe. I mean a walk-in safe with all this stuff. And it was in another location, and they did mislabel the location as to where it was, but we were able to reconcile all the bags of heroin that they were supposed to have in there. And there's two things that happened in that story. One is after we walk out, the GAO people are like, geez, that was great that you stood up to them, those guys are armed, right? And I was like, no. You mean I was almost became a bag of heroin myself? No, I didn't know they were armed. If I known they were armed, I would have dismissed myself to lunch and never came back. Two, the real moral of this story is that the IGs lost their objectivity. They were so often on that engagement looking at customs, and when we looked at the rotation, those IGs had been on those engagements for so long that they felt a part of the entity that they were supposed to be maintaining professional skepticism with, right? That they leapt to their defense instead of being just as independent and just as professionally skeptical as I was about, no, we're going to find this today. It's not something that we're just going to, say, oh, well, we'll find it later. So that's why I believe in that rotation, because you lose your objectivity. You had a second question.
Yes. So I know that for like example, Deloitte, they do the consulting. Can they do? Because like the position that I'm going to is tax consulting. So I imagine they do their taxes, but then they also have consulting. So can they do both at the same year? So do like management consulting and then do the tax consulting?
Sure. What's listed on this slide is services that you cannot provide contemporaneously with the audit.
Oh.
Okay, so if you're doing tax consulting and you're consulting them in some aggressive position, aggressive tax position, that would preclude you from doing the audit. Okay, so if you're just preparing their tax return, but if you're saying, well, look, we think that we can save you, $10 million, $100 million in tax by taking this aggressive position, and we interpret the code this way, and if you get in trouble, we'll represent you to the IRS, etc. Now you've taken an advocacy role with the client. You would have to give up the assurance engagement, not the consulting engagement. Not if you're doing consulting in other areas. Uh-huh.
You said they rotated, the firm rotated every 5 years?
Yeah.
How do they verify if they rotated or not?
Well, our friends, there's two ways. One, our friends, the PCAOB, will look at that absolutely. Okay, so PCAOB samples so many audits every year, and they come in back behind and they look at audits of public companies. So that's done by the PCAOB. Okay, they sometimes call them peekaboo for that reason, because they come in and they'll look at public audits. Okay, now you're sitting there saying, oh, okay, well, what if it's, and this is a public company rule, okay, but just so you understand that there's something else other than PCAOB, there's something we call peer review. And what peer review does is a CPA firm of similar size or audit organization of similar size and stature will look at another firm. So a Big Four firm has another Big Four firm, a regional firm, another regional firm. Even my office, the GAO, we were peer reviewed by the Canadian auditors or something like that at some point. And what they do is they look at the system of quality control. And they see that you have certain things like partner rotation and that sort of thing. And then they pull a sample of audits, and they look to see that those audits were done according to standard, including any sort of peer review and stuff like that. Okay. All of this that we're talking about here, when we talk about Sarbanes-Oxley and all that, all of this I want you guys to understand is a prayer. It's a prayer that says, please, God, don't let anything bad happen again. That's what it is. Because what happens? She says, because the thought should be, okay, well, you got all this crap, and then here we go again. 2 years from now, we'll hear about, well, thanks. Guess what? All that time, they were... Right? So, I mean, we put all these things up in a prayer that the system will work, but... Okay. Types of audits and auditors. External auditors, CPAs. Operational auditors, internal and governmental auditors. Come on. Okay, governmental auditors, we're external. We're CPAs. Okay. Certified internal auditors, CIAs, okay, operational audit. Operational audit looks at economy, efficiency, So some of those engagements that I described to you, even though it was on financial statement audit, that HUD one was a good example of an operational audit. Okay, are they being effective? Compliance, okay, internal and governmental auditors. Compliance, are we in compliance with the laws and regulations? Most of the single audit work that I talked about earlier is done by private CPA firms. So it's not government auditors that are doing that. It's private CPA firms that specialize in that particular area. Okay, and that's called internal auditors. Forensic auditors can be fraud auditors. You can be a certified fraud examiner. Okay. They talk about fraud, but forensic auditors could do this. Let's say somebody dies without a will, and the family members want to come up with a equitable, fair distribution of the estate. They could get forensic auditors in there to talk about how that distribution should be made, etc. Right? So it's not just fraud. CPA, get certified. I think we talked last time. Everyone here is planning to get certified? Any interest at all in the requirements for the certification? Do we all know what those are? Okay, I'll tell you what. Let's spend a little bit of time with that. And then we'll take the break, and then hopefully we'll get into chapter 2 here pretty quick. But I'm going to go ahead. I think it's okay if we spend a little time. Let me try to find that. I know I have one of these here. Let me do it this way. Here we go. Okay. Okay. So, as I think you guys know, oops, let me get a different tool here. This is better. Okay. As you know, to sit, and I'll put this thing up on e-learning, to sit for CPA exam, Okay. You need your bachelor's degree, and that bachelor's degree has to carry with it 120 semester units. Okay. Now they tell us that those 120 semester units, 24 are to be accounting, 24 are to be business. Okay. So with that alone, bachelor's degree, 24 units of accounting, 24 units of business, you can sit for the exam. Okay. Now, when we go for licensure, they expect us to have 30 more units. Okay. Thus the so-called 150 unit requirement, which is what? The 30 plus the 120 brings us to a bachelor's degree and 150 semester units. Okay. But these 30 more are when you go for licensure, right? Okay. Now, when they tell us 30 more, 20 are to be accounting and 10 are to be ethics. So that's how they comprise the 30 additional units that bring you up to the 150. Now, before someone panics and says, you mean I need 44 accounting units? No, because they tell us that of these 20 accounting, only 6 have to be actual accounting classes. Okay, up to 14 of these can be business classes, including mathematics counts as a business class. Okay, so if you look at the big picture here, it's what? It's actually 30 accounting units and 38 business units that are ultimately needed for the license. Okay, now for many of you guys, since you're all masters, I think you're all master students in here, right? You would be waived the requirement of having to get the additional 20 accounting units. By doing that, that allows you to do what? To use all of the accounting classes, all of the business classes that you'd be getting in your master's degree, and do what? Use them for the sitting requirements, and you're automatically deemed to have met the additional 20 accounting. And if your undergraduate was in some other discipline, then you'd probably have the 150 units that you need, right? Okay, so they won't require you to get those additional 20 accounting if you're a master's student. Okay, so for most of my master's students, the challenge is what? The challenge is getting these ethics units. Okay, and when we get to the ethics category, this class will get you some ethics. Okay, up to 7 units. Classes having these words. Okay, organizational behavior, that sort of thing. Everyone has to have the accounting ethics class, which I think is a requirement for the master's degree. So once you take that accounting ethics class, that'll cover that 3-unit class that everybody has to have. Okay?
Wait, so if you're not gonna take the accounting ethics class, just like business law, that wouldn't qualify for that?
No, you have to take the accounting ethics class. You must have 3 units of that. You can get up to 7 units in classes like auditing, business law, that sort of thing, but you're capped at 7. To round out the 10, 3 units must be the accounting ethics class. That's why Golden Gate makes you take it. Now, as a side note, I'm trying to get Golden Gate to allow the undergraduate students to take that class too, because they're opening up an undergraduate degree. And I'm like, well, you're going to leave them holding the bag for that 3-unit class. They're going to have to go outside the institution to take it. I just got done winning that battle at San Francisco State because San Francisco State didn't have it at the undergraduate level either, and I kept pounding on them. You got it. It's stupid. I advise students, and I have to tell them, and then when you go to take the 3-unit accounting ethics class, go to College of San Mateo. Go to Foothill College. Go to City College. All the community colleges are smart. They're offering that class, and the universities are somehow thinking that that's going to lead people into the master's program. I'm like, no, it's not. They're just going to go take it at a community college. The state doesn't care. As long as you take it from an accredited college, it doesn't matter. You don't have to take it. But it's a shame to have, it's like sending your child out and saying, well, now, go get your own dinner. We've given you everything, but now that it's Christmas, go buy your own turkey or something. I don't know. But it just seems, unfair to send the students out to another institution. So I'm hoping they're hearing me on that here as well. But that is pretty much the requirements. And of course, then you have to get 1 year of experience working under the supervision of a CPA. It doesn't have to be a California CPA. Okay, it can be a CPA in any of the 50 states. It could be a foreign CPA, but they will need a letter from the appropriate state board jurisdiction saying that person's in good standing. Okay? Yes, sir.
Does the year have to come after you pass exams?
No. It can be acquired before, during, and after. Okay, the only limitation on experience is that if the experience that you're claiming is older than 5 years, they will make you, so your experience was 5 years ago, and somebody signs off on the experience of 5 years ago, they'll still accept that experience, but they're going to make you update your experience by taking 40 hours of continuing professional education. Hours, not units. So you're going to have to take a week's worth of training, 8 hours a day, 5 days a week, whatever, 40 hours of training, and that can update your experience. Okay? There's no limitation on how long the exam lasts. Once you pass the exam, it's good for life. In fact, they won't let you take it again because some crazy people called and said, can I take the CPA exam again? Because I figured I'll take it again, and that'll help me to teach the CPA exam. And they were like, huh? What? And they put me on hold, and I think they were going, there's a crazy person on the phone that wants to take the CPA exam again. They came back and they said, no, you can't take it again. So they don't want someone like me getting into the business of taking the exam over and over and over again and then telling, 500 of my closest friends, how to pass the exam. So I mentioned last time I'm still working on trying to get Becker review course to have a live course here on campus so that you guys can kind of complete the exam and everything right here in-house, and we may be able to pull that off. We'll see.
Wait, did you say when you take the exam it's not going to expire?
The exam never expires.
But didn't you have like 18 months to complete?
You have 18 months, yes. Once you pass all 4 parts, it never expires.
So before you finish, if you pass one, you have to be finished 4 of them in 18 months.
You have to finish the remaining 3 in 18 months.
If you don't pass it, what expires?
Then you lose the first one. It's a rolling 18 months. So if you take the first exam and then for some weird reason it takes you more than 18 months to pass the remaining 3, you lose that first one. Now you got to hurry up and repass that one and pass the last one that you weren't passing before the second one's 18-month clock expires. So have you ever fixed your bed and you pull the sheet and you pull it and then it goes flump on that side, and then you run over there and you pull it down and then it goes boom? Did you ever have that happen to you? That's sort of what that's like. Now all of a sudden, boom, and finally you just cry yourself to sleep on the floor and cry yourself to sleep, right? Okay, so we don't want that. Okay, there's absolutely no reason for it to take you more than 18 months to finish the other 3 once you pass one. There's no reason for that, other than a fear of failure. I mean, a fear of success, I should say. Because you've passed one. I can get you through all 4 in 6 months. There's absolutely no reason to drag this out. It's not like, I love taking the CPA exam. Let me get a 74 so I can take this part again. CPA exam. Let me take it one more time. Okay, so it's like the Band-Aid. I'm done. Ow, but it's over with. Okay, so I can get you through in 6 months. So there's absolutely, people make a big deal out of this 18 months. You know why? Because they want to make you feel like you need them. Like there's this big scary process out there that's going to take you through an 18-month journey, and you can't navigate that journey unless I lead you through it. So they talk about the 18 months and all that all the time. Meanwhile, I'm like the doctor that says, let the kid have chocolate. Let him have chocolate because I can cure him of the problem. We're just going to do this and that. 6 months. We're done. There's no reason to drag this on more than that. Maybe 9 months. The reason I say maybe 9 months, sometimes I have students that fail that first exam because they're not sure everything that's involved. They fail the first one, but now that they've seen the exam and they hear what I'm showing them, then okay, I got this. And so we add another 3 months on to repeat that one exam. There's no reason it should take 18 months. That's 3 times as much time as you need. And that's my computer telling me shut up. So I will shut up, unless there's other questions. Okay, guys, I'll tell you what. Let's take the